Good day, and thank you for standing by. Welcome to the Kraft Heinz Company first quarter results. At this time, all participants are in a listen-only mode. After the speaker's presentation, there will be a question-and-answer session. To ask a question during the session, you will need to press star 11 on your telephone. You will hear a message advising your hand is raised. To withdraw the question, simply press star 11 again. And be advised that today's conference is being recorded. I would now like to hand the conference over to Anne-Marie Megela, Head of Global Investor Relations. The floor is yours.
Thank you, and hello everyone, and welcome to our Q&A session for our first quarter 2023 business update. During today's call, we may make forward-looking statements regarding our expectations for the future, including related to our business plans and expectations, strategy, efforts, and investments, and related timing and expected impacts. These statements are based on how we see things today, and actual results may differ materially due to risk and uncertainties. Please see the cautionary statements and risk factors contained in today's earnings release, which accompanies this call, as well as our most recent 10-K, 10-Q, and 8-K filings for more information regarding these risks and uncertainties. Additionally, we may refer to non-GAAP financial measures, which exclude certain items from our financial results reported in accordance with GAAP. Please refer to today's earnings release and the non-GAAP information available on our website at ir.kraftheinzcompany.com under News and Events for a discussion of our non-GAAP financial measures and reconciliations to the comparable GAAP financial measures. Before we begin, I'm going to hand it over to our CEO, Miguel Patricio, for some brief opening comments.
Well, thank you, Anne-Marie, and thank you everyone joining us today. We are proud and confident. We are so confident that we are raising our guidance on EBITDA and earnings. We are so confident that we are increasing our investments in marketing and in R&D by $100 to $150 million versus budget, which represents a solid double-digit growth versus previous year. These results are not a coincidence. They are because of our confidence. We have been consistently saying that we'll grow through emerging markets, and we grew 23% this quarter. We'll grow through food service globally, and we grew about 29% this quarter. And we'll grow through our priority growth platforms in U.S., Easy Meals, and Taste Elevation, where we had double-digit growth. The rest of the portfolio has to free up resources to invest in our strategy. These results are possible not only because of our strategy, but because of everything that is behind our strategy. Let me start with people. Today we have a great team and very engaged team. Speed. Well, agility is a big word for us, and the pods that we have in place are transforming the company in innovation, in supply, in manufacturing, procurement, in sales, in logistics. And two good examples of that is innovation, where we have now a much stronger pipeline for the future, and we reduced the time of innovating from 2 years to a couple of months. Or in supply, that through the pods plus the partnership with Microsoft and the usage of artificial intelligence, we are improving our planning, our service levels, reducing waste, reducing fines. We are in a very different place today. And finally, efficiencies. When we announced 3 years ago a $2 billion in 5 years of gross savings, there were a lot of people that were skeptical. That represented $400 million per year. We not only delivered this number in 3 years in a row, but we are now increasing this bar to $500 million a year. With that, I have here with me today Andre, our CFO, Carlos Abrams-Rivera, our Zone President for North America, and Rafael, our Zone President for International, that are joining me. Please, we are ready for the Q&A.
Thank you. And as a reminder, that is star 11 if you have a question. One moment while we compile the Q&A roster. And our first question comes from Brian Spillane with Bank of America. Please proceed.
Thanks, operator. Hey, good morning, everyone. I just wanted to ask, I guess, two questions related to the U.S. One is, I think, as we kind of strip out the food service piece and look at what's underneath, it looks like there's a bit of a mismatch, I should say, between kind of what we were seeing in the Nielsen data and what would have been reported underlying. So just trying to understand if there was anything there relative to timing of shipments or promotions that might have affected the cadence. And then second, if you can just talk a little bit about, in the U.S. specifically, kind of how you're seeing the promotional activity or the promotional environment as we kind of head into some of the big summer holidays. Is it intensified? Is it kind of in line with your expectations? Just kind of how you're seeing those summer holidays set up, please.
Andrea, please. Okay. Good morning, Brian. Good to hear from you. Thanks for the question. Look, when you look at the U.S. performance, I don't think there is nothing abnormal happening in the quarter. The inventory load was immaterial, given where already landed at the end of Q4, as I said before. So it's really a function of the sellout and the food service, which performed very well in the quarter in the U.S. zone. So maybe people underappreciate a little bit the impact of that. I believe it has something to do also with the fact that last year with Omicron and things, everything was shut down. So that impacted the sellout in retail in the industry at the beginning of the quarter, but also helped a lot food service to have a very strong performance. When it comes to promotions, as we have said all along, we expect an increase in promotions year to go. That's what has been in the guidance on our plan from the beginning, so nothing changing there from that regard. Always in a prudent way, and always emphasizing that well before 2019 levels. And you saw in prepared remarks how well we are doing in terms of continuing to improve our ROI with the tools that we have in place. And so nothing abnormal. I'll give some color to pass over to Carlos to give some color on the promotional environment.
The one thing I guess I would add, Brian, to what Andrew just said is, as he mentioned, the ROIs continue to improve. But let me give you a little more color as to what's behind that. We have spoken about the agile scale and how that has re-engineered kind of Kraft Heinz. And part of that is us creating ownable agile revenue management tools that actually allows us to improve the returns of our promotion. So, like, for example, we have a trade management system that we created in-house, and it gives us real-time access to essentially over 10,000 promotional events. And then what we do is we actually create digital tools that leverage that large amount of data to provide insights and recommendations in a very simple way. Now, those solutions then help us to make sure that allows us to figure out what is the right depth of discount, what is the right time of the year, and what are the right promotional tactics we have doing. So if you look at our Q1 numbers, we saw about a 10-point improvement in ROI in this particular quarter versus what we saw a year ago. And it's about 15 points if you compare that to 2019 Q1. So again, our ownable tools continue to help us make sure that we are driving that investment. So, as we go forward, our continued focus is make sure that we invest in the business, that we are focused on the renovation of our business, the marketing, driving a stronger quality with those event-based activities that really have the high ROIs. And Rafa, I don't know if anything you wanted to comment on what you're seeing in international promotions.
Well, it's not very different than what you described, Carlos. I think, and what André mentioned, we might see a bit of an increase. We'll see a bit of an increase in some markets in promotional activity throughout the year to go, but nothing significant that is not included in our guidance.
Thanks, Brian.
All right. Thanks, guys.
Thank you for the question. One moment for our next. and it comes from the line of Andrew Lazar with Barclays. Please go ahead.
Great. Thanks. Good morning. I think you outperformed expectations, obviously, in the first quarter on organic sales growth and maintained the full year outlook. I guess, potentially implying slower go-forward trends maybe than originally planned for. Is there something you're seeing in the market that necessitates this adjustment, or is this more a function of sort of conservatism? And I appreciate the full year outlook is already above your sort of long-term algorithm.
Hi, Andrew. André, maybe you want to answer that question.
Sure. Good morning, Andrew. We'll hear from you too. And thanks for the question. No, there is nothing that changed expectation. We are holding the guidance in top line. And if I look at versus what I believe market was expecting, we over-delivered quite a lot in the international zone, which I think people still don't fully appreciate the impact of emerging markets growth in our portfolio and the food service portion of the international market in our portfolio as well. They've been performing extremely well, as Miguel indicated, and they continue to do so. Momentum is very solid. When it comes to the U.S., nothing changed in our internal expectations. We just think that at this moment it's good to be prudent given macroeconomic uncertainties about interest rates and how consumers might respond on that, but nothing special.
Great. Thank you so much.
Thank you. One moment for our next question, please. And it comes from the line of Ken Goldman with J.P. Morgan. Please proceed.
Hi. There's been some anecdotal evidence that consumers are beginning to trade down in terms of where they're doing their grocery shopping, either going from premium channel to more mainstream or mainstream to discount. I'm curious if this is something you're starting to see as well, even if it's just on the margin. And if so, is it in any way, I guess, informing your decisions about product mix, new products, things like that?
Okay, maybe André and Carlos can comment.
Yeah. Good morning. Look, as you have seen since last year, the channel migration has started. So we don't see like an abnormal accelerated trend toward that. We have seen consistently now for several months the dollar channel and the mass merchandising gaining ground consistently. And as this is not a new phenomenon, we have been prepared for that for a while. So I'll pass to Carlos to talk about the type of activities we are doing in those channels, but we don't see anything abnormal happening, and it's expected.
Yeah, well, what I would add in terms of color, I guess first in retail, there have been some channel shifting, which we expected, and for the lower income consumers, this means kind of moving to more value-focused retailers or into dollar channel, and as Andrew said, we anticipated this. Now, for higher income consumer, that also means thinking about what are the places that it can go in instead of maybe the specialty retailers to more traditional grocery and club. And for us, what we're looking to do is actually making sure that we have the right solutions for those that are specific channels. So whether that is more club-sized packaging in brands like mac and cheese and Jell-O and adding more dollar SKUs so that consumers who are stretched are actually able to stay within the category. And then, as we talked earlier, being savvy about how we go about our promotional activities in certain categories so that we can, in fact, be there with consumers with the right overall kind of meal solution. So if you think about what a grilled cheese sandwich can do with Kraft singles, what Kraft mac and cheese can do in terms of families, what Oscar Mayer hot dogs can do, us being able to be there for those kind of meal solutions is part of our answer as well. The one other thing I will say is if you look at that same channel shift within food service, we're also making sure that we are adjusting too for that. We are seeing how our business continues to grow in QSR, and for us, it's continued to grow that business, and we are doing that, and we're growing share of that business as well. So it's making sure that our consumers are shifting from certain restaurants to QSR. We are making sure we are there for them too to continue to drive our products and continue to drive our growth, which is the way it resulted in Q1. So thank you for the question, Ken.
Thank you. One moment for our next question, please. And it comes from the line of Jason English with Goldman Sachs. Please proceed.
Hey, good morning, folks. Thanks for slotting me in. Two quick questions. First, the gross margin outlook for the year. Great to see it moving up. It implies that your gross margin for the year is going to look a lot like your first quarter, which would, of course, mark an end to what has been like a sequential build with every quarter moving higher. I guess my question is, why would that be the case, especially given that cost inflation appears to be moderating?
Okay. Sorry, Jason, could you repeat the question, talking about the trajectory of the gross margin throughout the year?
Yeah, gross margin's been building sequentially, right? You even have a chart in one of your slides showing it every quarter moving higher. Your full year guidance implies that it kind of goes sideways, that you're going to finish the year at a margin rate very comparable to the first quarter. So my question is, why shouldn't we expect it to continue to grind a little higher as cost inflation moderates?
Yeah. No, the gross margin will increase a little bit throughout the next quarter, so we should see Q4 will be the highest one. Q2 goes a little bit sideways. There is a component of mix in our portfolio as well, given the type of products that sell more during Q1 and Q4 in comparison to what sells in December. But beyond that, no, because the costs are continuing to ease. The price we put a lot of price in the middle of the quarter, so we have full reflection of that now in Q2. But remember as well, and then we're going to start to lap something from last year, right? But no, the gross margin will gradually increase throughout the year.
Okay, that's helpful.
And it's the expectation that you read is because of product mix, which mostly seasonality.
Yeah, that's helpful. I appreciate that. And then free cash flow. Can you tell us what your outlook is for the full year in terms of conversion or level, however you want to communicate that? And I know you talked about working inventory down. It built a lot last year, and obviously there's still a heavy usage of cash again in the first quarter. How much of that do you think we could get back out over the course of this year, or do we have to kind of bleed into next year before we can normalize those levels?
Yeah, so free cash flow, as we said last quarter, we expect this year to close in the 75 to 80% range, which is in line with our plan. We even talk about that in CAGNY, and then we expect by 2025 to go up to 100%. This has to do mainly with the CapEx ramp up that we have done this year and next year, which is close to 4%, and then expect to wind down. Working capital, yes, was a drag last year, and in Q1 was also a negative hit. We prioritize service level recovery because, I mean, the payback is obviously there. What I can tell is we have a very robust plan to bring the inventory down to level before. We have been working with buffers, I mean, as everyone in the industry does, given all the uncertainties about supply chain volatility and resilience. But we have a very clear line of glide path to bring it down throughout the year. So the expectation for inventory is to land the year at similar levels to where we were at the pre-pandemic level as a percentage of COGS.
Got it. Thanks a lot, guys. I'll pass it on.
Thank you. One moment for our next question, please. And it comes from the line of John Baumgartner with Mizuho Securities. Please proceed.
Good morning. Thanks for the question. I wanted to come back to promotion in the U.S., Carlos. There were a few categories that drove the bulk of U.S. share loss in Q1, but I think those are also categories where your promotion levels really seem below branded competitors. So is it fair to isolate the share losses to reduce promo and lingering supply chain issues, or are there other factors in play outside of promo and supply chain?
No, listen, John, I think that's a fair assessment, but I guess let me start with the fact that as we think about growing the business, you know, we have a very disciplined approach of how we're going to do that. So we are, as Miguel mentioned, we're going to focus on our growth platforms and the role they have in our portfolio. We want to make sure we're building innovation that's disruptive and that we continue to adapt the core to the consumer trends. And we're going to manage the margin with efficiency to reinvest in the business with, you know, with the double-digit investments in marketing, technology, and R&D. And as you said, there are a few kind of categories where we saw it slow down. And let me remind you too that we took pricing in the middle of the quarter as we were catching up to margins. So if you think about a couple of those categories, let me highlight a couple of them. One, cream cheese, for example. We did see some supply chain challenges that we had in the quarter. Those are things that prevented us from really taking advantage of the Eastern time period, and in fact, we are now in a position that we'll be better off as we go into the year to go. Another one I'll tell you is cold cuts, in which we began the year with a low inventory situation in our business, and again, as we think about cold cuts by the end of the summer, we should be in a much better place in terms of completely supplying the overall business. So that sense of the short-term supply constraint, it's an assessment of how we see the quarter as well. The one thing I would add too is that there are places where in categories we're simply not going to be chasing volume down. So if you think about bacon, it's a category that that probably was about a point of headwinds when you look at the data and consumer data, but we're simply not going to be chasing volume that is not profitable. So that gives you a sense about how kind of we're looking at business and what drove that first quarter.
Okay, thanks, Carlos. And on the international side, your categories, I guess historically your categories have been pretty defensive in terms of demand during economic weakness. And I'm curious, you're doing a lot of good things, ramping distribution, launching new products. But as you transform the business with growth in food service, the new sauces, the beef partnership with ABI, how do you think about the marginal structure? Are these new outlets and products introducing greater volatility into the business, or do they benefit you in that they reduce some of the impact of private label and price sensitivities in places like the UK and Europe? How do you think about the net resilience you're building outside the U.S.? Thank you.
Rafael, do you want to answer that one?
Yeah, no, happy to. I think we need to differentiate a bit how we're growing in emerging markets and the developed markets across international, right? And, I mean, what you described probably applies a lot to the developed markets because, as you know, as we've been talking about, across emerging markets, we are growing significantly, and the go-to-market and the opportunity we have in execution of this go-to-market has been significant and continues to be. On the developed market, I mean, it's a mix. I mean, we've been renovating our portfolio significantly in all the places, especially you mentioned Europe, and then launching products that have been incremental, not only in sauces, but in the meals category. Like those are the two platforms that we've been growing, especially the sauces that take elevation. So this has been the focus. I mean, right now is delivering the results that we expect. And again, providing the gains that we need and the resources we need from the core and the innovation growth that comes from those introductions.
And just to add to that, if you remember, again, international zone, you have the developed markets and the emerging markets, right? The emerging markets, 10% of our business. We expect to grow double digits like we have been doing. There's a different game plan about expanding distribution, but it has to be done in a profitable way. And you might have noticed in the prepared remarks that since we start to require from our emerging markets a certain level of minimum ROIC or EVA, I think we're seeing a very healthy balance between top and bottom line. And we saw very significant gross margin expansion in emerging markets across the board in the quarter. And I think with expectation for that to continue to improve. So we feel very good that part of the investments that Miguel has said about the $150 million, which is going across marketing, R&D, technology, and in some cases, sales headcount. In the case of emerging markets, we are accelerating the go-to-market expansion. Again, we always keep profitability top of mind here. We don't want to grow without delivering returns. And on the developed markets, not only in the U.S., but also in selected countries being developed, we are using part of these incremental investments to reset the marketing levels and accelerate, in some cases, the innovation agenda. So we feel very good because that allows us to continue to build the future growth of the company.
Yeah, let me mention one thing that you mentioned that entering new categories with innovation. You're right. I mean, we launched in UK Heinz pasta sauce, and in a couple of months we achieved 7% share, and we continue growing. We just launched a vodka pasta sauce with Absolute that is being extremely successful in the market. But it's not only in Europe. I mean, if you look at the profile of innovation that we are having right now in the U.S., it's very different from the past. In the past, we had a lot of innovation, but really not incremental. It was very cannibalistic. But just think about what we've been launching, like Notco, that it's going to be national during the summertime. It's basically 80% incremental to the category. Or just spices that we just launched in the U.S. through direct to consumer, which is spices, which is a huge market where we don't play today. Or tingly tabs that we are launching globally throughout the year. And that is in hot sauces. That is a pretty growing category that we were not playing. Or even Kraft mac and cheese frozen that we are launching, that we are leader in Kraft mac and cheese. With Kraft mac and cheese, we have a very strong portfolio of frozen, but we didn't have an option of Kraft mac and cheese frozen. And I can continue this list and tell you about home bake and crisp from microwave, really, really incremental innovation that will start to change the profile of innovation in our company.
Operator, we have time for one more question.
Thank you. One moment, please. And a question comes from Stephen Powers with Deutsche Bank. Please go ahead.
Oh, great. Thank you. I just wanted to follow up on the supply topic. It sounds like you've made good headway and have good visibility to improvements going forward. But I guess just framing that, is there a way to think about what the supply challenges in the first quarter cost you? And then as you move forward with those supply bottlenecks resolved, do you kind of resume a more normal growth trajectory in those categories with with those issues behind you? Do you accelerate a catch up over the next couple of quarters as you dig out of the hole, or is it more prudent for us to think about a more gradual ramp of recovery again as those issues abate? Thank you.
Andre, maybe Carlos then.
Okay. Good morning, Stephen. Thanks for your question. Look, we always expect as some of the solutions, the problems get solved, as Carlos indicated, we expect over time to be reducing inventory at the retailer, and that should come together with some improvement in the top line performance. But again, it's all contemplated in our guidance here. Remember that our priority in the U.S. is to grow in the growth platforms. And the priority growth platforms have performed very well in the first quarter, particularly Taste Elevation and Easy Meals. But we expect categories like cream cheese to improve their performance throughout the year as those problems get behind us. In other categories, like in meats, as Carlos also said, not necessarily we're going to be a strong acceleration in growth because we're also trying to be prudent about having the profitability there. So it's about having the right balance. But yes.
Yeah, I mean, there's not much to add. What I would say is we continue to see the improvements in service levels. So just to give you kind of a framework, last year, I think at this time of the year, we were kind of in the mid 80s. We are now, in the mid 90s, actually closer to the high levels of 90s. So as we exit the first quarter, so I feel like, we do have a couple of categories that I mentioned earlier where we have some isolated challenges, but overall, the business, we are certainly in the right trajectory to continue to service the business the right way as we go forward.
Thank you very much.
Operator, that'll be it for the Q&A session. I'd like to turn it over to Miguel for some closing comments.
I just want to thank you for the time you spent with us and looking forward to sharing more information and more results with you. Thank you so much.
Thank you. And with that, we conclude today's conference call. Thank you for your participation. You may now disconnect.